There is a lie that keeps the middle class trapped in the rat race until they die. It is the lie that income comes from labor. You are taught from birth that to make money, you must trade your time. You trade an hour of your life for a paycheck. You trade your energy for a deposit. And when you stop working, the money stops flowing. This is not financial freedom. This is financial servitude. The wealthy operate on a completely different operating system. They do not work for money. They build engines that extract value from the economy day and night, regardless of whether they are awake, asleep, or on vacation. We are entering the great wealth transfer. As the older generation passes on, trillions of dollars in assets are changing hands. But unlike the crypto markets, which are volatile and speculative, there is a class of assets that form the bedrock of the global economy. These are the companies that own the world, the companies that you pay every single day, whether you like it or not. You want to escape the matrix? You don't just need a fast car, you need a fortress. You need a cash flow machine that replaces your salary, dollar for dollar, until your labor becomes optional. In this transmission, I am going to break down the architecture of the dividend portfolio. We are not talking about gambling on penny stocks. We are talking about becoming a partner in the monopolies that rule the world. I will reveal the specific sectors and companies that have survived wars, depressions, and pandemics, and continue to pay their shareholders every single quarter. This is how you stop being a consumer and start being an owner. Let's begin with Phase 1, the philosophy of the rent seeker. Why dividends? In a world of AI stocks and crypto pumps, dividends seem boring. Boring is exactly what you want when you are building a fortress. Most investors focus on capital gains. They buy a stock at $100, hoping to sell it to a greater fool at $200. This is speculation. You only make money if you sell the asset. And if you sell the asset, you kill the golden goose. The sovereign individual focuses on cash flow. You buy the asset and you never sell it. Instead, you collect the rent. When you own a dividend-paying stock, you are claiming a portion of that company's profits. When Coca-Cola sells a bottle of sugar water anywhere on the planet, a fraction of a cent travels through the banking system and lands in your account. You didn't drive the truck, you didn't stock the shelf, you didn't run the ad campaign, you simply held the paper. This is the closest thing to free money that exists in physics. It is the labor of thousands of employees working for you. But not all dividends are created equal. This brings us to Phase 2, the trap. The biggest mistake novice investors make is yield chasing. They see a company paying a 10% dividend and they get greedy. They think they have found a glitch in the matrix. Let me be clear. In the stock market, a risk-free 10% yield does not exist. If a company is paying 10%, it is usually because the stock price has collapsed or the business is dying. This is a yield trap. If you buy a dying business just for the dividend, you are picking up pennies in front of a steamroller. The company will cut the dividend, the stock price will go to zero, and you will lose everything. The sovereign protocol requires a filter. We are not looking for the highest yield. We are looking for the safest yield and the growing yield. We are looking for the aristocrats. An S&P 500 dividend aristocrat is a company that has not just paid, but increased its dividend for 25 consecutive years. Think about that. Through the dot-com crash, through 9/11, through the 2008 financial crisis, through the global pandemic, through all of that chaos, these companies sent a bigger check to their owners every single year. That is not luck. That is dominance. Now, let's identify the specific sectors where we can find these machines. Sector 1, the addiction economy. You want to invest in companies that sell products people cannot live without. Products that are addictive, either chemically or psychologically. Look at the consumer staples sector. Companies like PepsiCo or Procter & Gamble. When a recession hits, people stop buying new cars. They stop going to Disney World. They stop buying luxury watches. But they do not stop brushing their teeth. They do not stop washing their clothes. They do not stop buying snacks. These companies have pricing power. When inflation hits and the cost of raw materials goes up, they simply raise the price, and the consumer pays it. This makes these stocks a natural hedge against the inflation that is destroying your savings. Sector 2, the energy grid. The modern world runs on energy. Without it, civilization collapses in 3 days. While the world transitions to green energy, the reality is that oil and gas will power the global economy for decades to come. The oil majors, companies like Chevron or ExxonMobil, are cash cows. They generate billions in free cash flow. They are not high-growth tech startups. They are mature, massive empires that return cash to shareholders. Then you have the midstream companies, the pipelines. These are the toll roads of energy. They don't care about the price of oil. They get paid by volume. As long as energy is moving from point A to point B, they collect a toll. This is a reliable, high-yield sector for the income-focused investor. Sector 3, the landlords, REITs. Real estate investment trusts allow you to own commercial real estate without the headache of fixing toilets or dealing with tenants. But you must be surgical. Commercial office space is dying because of remote work. Malls are struggling because of Amazon. Where is the value? Data centers and essential retail. Every time you use AI, every time you stream a video, you are using a data center. These are the physical warehouses of the internet. Owning the landlords of the cloud is a play on the future of technology with the stability of real estate. And then there is Realty Income, the company literally known as the monthly dividend company. They own thousands of convenience stores, pharmacies, and grocery stores. Their tenants are on long-term leases. They pay you rent every single month. It is boring, and it is beautiful. Phase 3, the growth hybrid. If you are under the age of 50, you cannot just hold slow growth companies. You need dividend growth. There are tech giants, companies like Microsoft or Apple, that pay a small dividend today. Maybe less than 1%, but they are growing that payout by 10 or 15% every year. Buying these companies is like planting a redwood tree. Today the shade is small, but in 10 years, the yield on your original cost will be massive, and the asset itself will have doubled or tripled in value. This is how you build generational wealth. Now, let's discuss the strategy, the snowball effect. How do you execute this? You do not need $1 million to start. You need a system. The system is called DRIP, Dividend Reinvestment Plan. When your portfolio pays you a dividend, you do not spend it. You do not buy dinner with it. You immediately reinvest it to buy more shares of the same company. Here is the math of the snowball. In year 1, you own 100 shares. They pay you dividends, and the DRIP buys you 3 more shares. Now you have 103 shares. In year 2, those 103 shares pay you dividends. Now you can buy 4 more shares. In year 10, you are buying dozens of shares every quarter without adding a single dollar of fresh capital. The machine is building itself. There is a specific number you are chasing. It is called the crossover point. This is the moment when your monthly dividend income exceeds your monthly living expenses. The day you hit the crossover point, you are free. You can walk into your boss's office and quit, not because you hate the work, but because you no longer need the money. You have regained your sovereignty. But there is a warning. The great wealth transfer is not just about assets moving from boomers to millennials. It is about assets moving from the uninformed to the informed. Wall Street is designed to take your money via fees, trading costs, and bad advice. They want you to trade. They want you to gamble on earnings reports. They want you emotional. The sovereign investor is a stoic. When the market crashes, the sovereign investor does not panic. They smile, because a market crash means they can buy more streams of income at a discount. If the price of a cash-flowing machine drops by 30%, but the cash flow remains the same, the yield has just gone up. A crash is a sale on freedom. Phase 4, the portfolio construction. Do not put all your eggs in one basket. A sovereign portfolio is like a Parthenon. It needs pillars. Pillar 1, high yield, REITs, energy. To generate cash flow now. Pillar 2, dividend growth, staples industrials, to protect against inflation. Pillar 3, cash hoard, short-term treasuries. To buy opportunities when blood is in the streets. You must build this brick by brick. Start today. Look at your expenses. How much does your Netflix subscription cost? $15? Your first goal is not $1 million. Your first goal is to buy enough dividend stocks to pay for your Netflix subscription. Once you achieve that, you have eliminated one bill forever. Then, aim for your phone bill, then your car payment, then your rent. You are conquering your life, one expense at a time. This path requires patience. It is not a get-rich-quick scheme. It is a get-rich-permanently scheme. The world is noisy. The news will tell you the sky is falling. The crypto bros will tell you dividends are dead. Let them talk. While they are glued to the charts, stressed and anxious, you will be sleeping soundly, knowing that the greatest companies on earth are working tirelessly to send you a check. The great wealth transfer is happening. The capital is moving. Will you be a destination for that capital, or will you let it pass you by?